Joining me today is Bill Baruch, president of Blue Line Futures. Bill, welcome back.
Thank you for having me.
Let's start talking about these tariffs on China. Chinese officials retaliating with targeting $3 billion worth of U.S. goods, but markets barely responding to this news. So how do you see it?
Well, we saw equity markets take a big hit yesterday, and ultimately it caused a safe haven bid in gold. But ultimately, the geopolitical tension is why we're seeing that safe haven bid. But on the other end of the spectrum, this is inflationary. The cost of goods is going to be more expensive, and it starts to spark those inflationary hedges from gold. So gold is really liking this from both ends of the spectrum.
So focusing on the Fed now, Bill, I had a lot of readers confused as to why the higher interest rates are actually moving gold higher here.
That's a really great question. And what I always turn to is I look back to December of 2016, and the Federal Reserve will never be as hawkish as they were at that time relative to perception. The dollar index traded to 103, and gold was crushed. But ultimately, since then, we've seen the Fed take a less hawkish turn while hiking rates. They will never be able to hike rates at a rate or at a pace faster than the market is pricing in. And they almost were able to do that with 4 hikes this year on the dot plot. And the failure to do so was very bullish for gold. And not only that, we're going to see the ECB could potentially start hiking at the end of this year or early next year. And that's going to strengthen the euro against the dollar. And you're going to see the Bank of Japan start to tighten at some point in the next 12 to 18 months. That's going to increase the yen against the dollar. And all of that is going to be very bullish for gold, not necessarily because of the monetary policy around the world is tightening, but because the dollar is going to continue to weaken. And the dollar started that rally in 2014 when they were the only ones in the street tightening. Now, this whole rally from 2014, the dollar is being unwound.
So Bill, given the events of this week, have you changed your forecast for gold here?
Well, I have been calling for gold to break out above 1,400 sometime in this summer or by August at the latest. I hope to see that a lot sooner. We're pressing a trend line at 1355 with another resistance level of 1351. So there's a pocket there that I'm watching. The market can get out above that. We should see another 1% in a hurry, about 1367, 1370. And that's the previous topping area. This is the third test up there, and really what the last about 6 months or so. And ultimately, if it gets out above there, I think we'll see another $50 pretty quickly. I'm less worried about 1,400. I think we'll get to 1,420.
All right, just some quick thoughts on silver.
Silver has been the laggard, but it's holding $16. I think that's pretty positive. We've seen a net short position in silver, and each time we've seen a net short position in silver, the commitment of traders, it's led to a big rally. I think gold's starting to get going, and silver's going to follow. As the 200-day moving average in silver, right around $17, and that's the psychological level. So let's call that the area that we want to see. If silver gets out above $17, it's going to start to run, and then there's a little bit of headwind about $17.75. But ultimately, if gold starts moving, I think silver's going to push, and at some point, silver's going to take the reins.
All right, good thoughts. Bill Baruch, thank you so much.
Thank you for having me.
And thank you for watching. We'll see you next week.